If you're self-employed in Alberta, there is one red flag that underwriters can spot immediately. I've seen self-employed people making great money who have a healthy business and still run into mortgage problems. Most self-employed people don't even know what this problem is, let alone where it shows up. Most of them think it's their credit, they think it's rates, they think it's because they wrote too much things off, but actually it's something completely different. My name is Ushindi Mutabazi. I'm a mortgage associate here in Alberta, and I specialize in helping self-employed Albertans like yourself qualify for a mortgage without waiting for the 2-year average, pay more in taxes, or changing the way that you run your business. And in this video, I'm going to be going over the first place underwriters look, what quietly makes them nervous, why most self-employed files sound strong in conversation but fall apart in review, and go over what you need to understand before applying to avoid getting blindsided. Now here's the mistake that most self-employed people make right away. They assume that if their business is doing well, qualifying for a mortgage should be straightforward. And on the surface, that sounds pretty fair. You're bringing in money, you're staying busy, you've built something real, so naturally it makes sense. You think, I'm earning well, why would qualifying be a problem? But the thing is, it can and might still be a problem because lenders do not approve how hard you work. They do not approve your hustle, and they definitely do not approve your revenue just because the number sounds impressive. What they do approve is the income story that they can verify and defend on paper. And that right there is where the problem begins for a lot of self-employed people. The number one red flag underwriters spot immediately is your income story not matching up with the documentation provided. And no matter how good you are at selling dreams, the underwriter is always going to trust the paperwork first. That is the part that most people miss. They assume that the underwriter is evaluating their business the same way that they evaluate their own business, but they're not. You're looking at what's coming in. Underwriter is looking at what portion of that can be used to qualify your mortgage. That being said, the good news is that this does not automatically mean you get declined. Just because an underwriter sees a red flag does not mean the mortgage is dead. But it does mean one of two things. Either the file needs a better strategy or the file got put into the wrong process, and that distinction matters a lot because sometimes the problem is not the borrower, the problem is how the file was positioned in the first place. So you might be thinking, where do they even find these red flags? Well, if you're a sole proprietor or a contractor, underwriters are usually starting with your T1 General, your Notice of Assessment, and your T2125. If you're incorporated, they're still looking at your personal side first, then how you pay yourself. Is it salary, dividends, or a combination of both? And depending on the lender and the structure of your file, they may require some additional supporting documents on top of that. Regardless of which one you are, the point is simple. Before the lender sees your business the way you see it, they see your paper trail. And that paper trail is either helping you or creating doubt. That is exactly why self-employed mortgages can be very frustrating because on your end, things are obvious. But on their end, they can't afford to assume anything. They need the file to tell the story clearly. And if it doesn't, they start asking questions. This video is sponsored by myself. If you're looking to buy a home in the next 6 months or just want some clarity on your current position and where you stand, click the first link in the description and complete my 3-minute mortgage readiness quiz. It's completely customized, and once you complete that quiz, I will personally record you a custom video within 24 hours breaking down your real numbers, explaining exactly how a lender would view your file, and laying out a clear approval strategy based on your timeline and your goals. This is not automated, it's me doing the work. Also, make sure to follow me on Instagram at @itsushindi for more self-employed mortgage advice, or if you have any questions and just want to chat, a link for that will be in the description as well. Let's get back to the video. You might also be thinking, why does this red flag show up so often? It's because self-employed people like yourself are usually making smart business decisions. But that does not mean those smart business decisions are automatically smart mortgage decisions. When you run a business, you're trying to be efficient, you're trying to structure things properly, you're trying to keep more of what you earn, you're trying to manage expenses and reduce unnecessary taxes where appropriate, which is 100% normal. That is responsible. That is how owners should be thinking. But the mortgage world is not rewarding you for being efficient. What the mortgage world is doing is trying to determine what income can actually be used to qualify you. And those are not always the same thing. Tax conversations and mortgage conversations are related, but they are not identical. Now, this is where people always simplify the problem and say, so the issue is write-offs. Not necessarily. The issue is not just write-offs. The actual issue is the overall income story your file is telling after everything is said and done. Sometimes the file looks lower than expected. Sometimes it looks inconsistent. Sometimes it looks hard to defend. And once that happens, the underwriter is no longer reviewing income. They are reviewing risk. And that's a very different conversation. This is where I want to introduce something that will make understanding this topic a whole lot easier. Lane A and Lane B. Lane A is when your file fits more naturally into standard lending expectations. Your documents show strong enough usable income, the story is relatively clear, the lender can follow it more easily, kind of like a regular taxed employee. But Lane B is when the business might still be healthy, but the paper story is lower, more complex, or less straightforward. Being in Lane B is not a bad thing. A lot of self-employed people are in Lane B. That does not at all mean you're a weak borrower. It does not mean you did anything wrong. It just means you need a different strategy if you're in this lane. The real mistake that people end up making is not being in Lane B. The real mistake is treating a Lane B file like it belongs in Lane A. That is exactly how you end up getting under-approved or declined. The file is getting measured the wrong way. It never had a chance in the first place. The expectations are off, the setup is off, and now you have a borrower who may have had a perfectly clean path forward ending up confused, delayed, or discouraged because the file was handled like a Lane A file when the whole time it should have been treated like a Lane B file. This is also why people get told yes early, then end up running into problems later on. The first conversation is often based on broad numbers, rough income, rough purchase prices, but if you're self-employed, rough assumptions are very dangerous. Revenue is not the same as qualifying income, and business strength is not the same as usable income. Now let's get one level deeper. What is the underwriter actually asking when they're reviewing a self-employed file? The underwriter is asking, can I verify this income? Is it stable? Is it consistent enough? Does this make sense based on the documentation in front of me? And if I approve this, can I defend the decision internally? That last one is very, very important. An underwriter does not just want the file to maybe work, they want the file to make sense. And the harder the file is to understand, the harder it becomes to support. So when your paperwork creates confusion, that confidence turns into friction, more questions, more conditions, more back and forth, and sometimes just no path forward at all. If you're looking to buy a home in the next 6 months, click the first link in the description and complete my 3-minute mortgage readiness quiz. Once you complete that quiz, I will personally record you a custom video within 24 hours, breaking down your real numbers, explaining how a lender would view your specific situation, and laying out a clear approval strategy based on your timeline, your goals, and whether you're in Lane A or Lane B. That way there's no confusion. Also, make sure to follow me on Instagram at Self-Employed Mortgage Guy for more self-employed mortgage advice, or if you have any questions and just want to chat, a link for that will be in the description as well.